Greetings, everybody. Jeff Scott here. Welcome to this week's review. I hope you all had a safe and happy holiday. I'm not used to taking 10 or 12 days off of work, so it was strange. Officially, I was working, but not much was going on. Spent the last 5 days out on my boat, went down to Key Biscayne, put out the jet ski and the tender. I had a great time hanging out with some friends from Baltimore. I titled today, Geopolitics, Derail Market Rally. And I probably should put a question mark because a one day of a bad market does not mean the market's done going up forever. As always, this is for education purposes only. Anything I recommend is in the spirit of education and should not be considered investment advice. I am a physician, not a broker. I'm independent. I spend a lot of time using HGSI. I am a user of HGSI. I get no financial consideration when people purchase HGSI, but I do like to see the product succeed because it's important to my trading, and I do support it, and I support it with these webinars. Trading involves risk. You alone are solely responsible for any investment decisions you make. It's funny, I talked with the guys and their wives on the boat, and everybody wants to know how I make money trading, and everybody wants to learn. For me, it's been I won't say lifelong, it's certainly been a 35-year journey since finishing medical school. I started learning about investing when I was in my residency and took it seriously when I went into practice. Of course, like everybody else, I went through the school of hard knocks. I blew up my accounts and everything else. And then I decided to get serious and got educated. I had to go to college, med school, do residency for 3 years and a fellowship for 3 years to become an oncologist. And it took time and money, investment, both. And it's the same thing when it comes to trading. I started by reading an earlier edition of How to Make Money in Stocks by O'Neill, followed up with Morales and Katcher, who used to work for O'Neill. Ian Woodward I met when he worked as a speaker for a company that went defunct called Telescan. And then he teamed up, as I mentioned before, George Roberts and started HGSI. Ron Brown, trades a different style than I do, but it's amazing how we always end up with the same type of stocks. Ron's a great guy, a great educator, and another strong supporter of HGSI. George Lee, I started going to meetings where he was speaking at and ended up of late sharing the podium with him, another great trader. Oops, sorry about that. Van Tharp, the king of money management, position sizing. Sagar has a number of great tools I use from Superior Profit and Q. And then my buddy John Person, who I started again as a customer. I walked into his office years ago and we became friends since. I use his tools in multiple different platforms, and I find them to be critical success factors for me, not just how to build a list of stocks, but how to actually trade them. So when I do live education, I call it be your own guru. And by that, I mean find smart people that you can learn from, be a sponge, and then create your own style, what works for you. What I need on my desert isle, I have lots of tools on my desktop. I spend most of my time with TradeStation and Thinkorswim and the various indicator packages, certainly during the market. HGSI, I use end of day, but you can also use it with a slight delay intra-market using real-time quotes from a number of sources. EdgeRater has automated a number of the things I used to do with spreadsheets, and then a number of other tools, including the tools from Sagar of SuperiorProfit.co. Here's the website for HGSI. Again, I have no financial affiliation here, but to point out two things, there's a free 30-day trial. They don't even ask for a credit card. And then under investing strategies, you'll find lots of movies. So one thing I told my friends on the boat, and I'll say it here, is it's a easy program to use, but it's not easy to figure it out when you just start the program. So I've created a series of educational videos, and one specifically that I do before all my live meetings is my vocabulary and the different indicators. So If you start using HGSI, if you're confused by my videos, all it takes is an email at hgsidoc@gmail.com, and I'll send you the video that I'm referring to. As I always talk about the market, it's important that you recognize that I'm a top-down trader. As a top-down trader, the most important thing that I believe will affect the market in my positions is the market itself. For example, on Thursday, with almost the same portfolio that I had on Friday, I was up massive on Thursday. I'll talk about that later. Well, on Friday, I actually was down, although not as much as I was up the day before. It wasn't I who changed. It wasn't my positions who changed dramatically. It was the market. I want to find the stocks in a strong market. I want to have a larger portfolio than in a weak market. I want to find those stocks that are in the best sectors at a given moment, best industry groups, and then I want to trade them based upon my conviction of the market. Every market, every stock goes through this pattern. Clearly it feels like we're at a high and about to correct some right now in this market. So are we beginning that stage 4? Or will this just be a repeat of what we've seen over and over again, which is another leg up? I apologize for the crying in the background. My dog is being a pain in the tuchus, which is Yiddish for the 3-letter word that starts with an A on your behind. Every index, industry group, sector, and stock will go through these patterns. You have to identify where these patterns are because it will affect how you trade the market. So if you look at my portfolio today, a lot still looks like the left, although to be honest, on Thursday, as the market got so overextended, I said to one of the guys on the boat, the market's going to go down tomorrow because of how much it went up today. So I started buying puts and did some things on my positions to protect them. Hence, I didn't go down nearly as much as I went up the day before. So I have a little bit of everything going on. I still have plenty of stocks, but I'm not sure I'm going to buy a lot at the open until I have a better understanding of what this market's going to do. I do believe that means I'll raise for more cash and smaller positions and continue to sell some premium if it looks like this market is going to pause here or pull back. But we'll see when the market opens. If we looked at Friday on the sector review, where's the strength? It's simple. It's on the defensive. My dog is spoiled. Plays. Energy popped because of the concern about raising fuel in the setting of the increasing tensions with Iran. Flight to defense on staples, utilities, and real estate, where the market was led on Friday. If we look at the major markets to understand what's going on, let's pull this up and let's just look at them one at a time. There hasn't been a big change among them for some time. Friday was interesting, and it remains to be seen whether it was a one-day blip, and we'll talk more about that, or if the market's ready to roll over. If I look at lower left, upper right, you can see that the high of the market for this year was actually set on Friday before the market opened and then sold off. So the high of the market was Friday. So are we instantly correcting from an all-time high? Not usually. Volume was higher than it had been, but still lower than it's been in the past. Not surprising that the volume picked up as more people returned to the market after the new year. This is the E-minis, and again, we set a high before selling off on Friday. If I look at the NASDAQ futures, it looks the same, as does the Dow futures, in that we did trade higher than we traded on Thursday, where we closed on the highs, but we sold off. Where it starts to look a little different, it's out to a full year. I'm sorry. Is when I start to get into things like the Russell 2000, which had been moving up nicely. Here's the IWM. Actually, on Friday, traded up throughout the day, but you could see it's in the midst of a new downtrend. The most previous high goes back 5 days ago to for the high of the year. It's not the all-time high. And notice how much it gapped down and moved its way up, but still closed down quite a bit on Friday. If the market's having this difficulty, we want to expect the VIX to rally, and it did. It failed at its 200-day moving average and came back. But that's still a very aggressive move, and I'll be watching that this week. And I still have some VXX, although frankly they've done nothing. And then here is the dollar, which actually rallied on the news on Friday. Overnight futures was down quite a bit compared to this, but during the day, the dollar actually rallied. So how do I put that together? We're near all-time highs. We've had one bad day. One bad day does not mean the end of the market, but we'll have to see. Again, if we look at the weekly, you can see fairly clearly the nice uptrends that everything had been in, and you can also see that we've not taken out our 2018 highs on the Russell. The VIX on the weekly doesn't look that impressive, and the dollar is in one of its pullbacks at this time. What else happened? Rates on both the 10-year on the left and the 30-year on the right pulled down a little bit. If I look at the yield curve, it's hard to see, but trust me, it pulled back just a tad this week as well. Now, as it says here, falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. And that rang through on my bottoms-up review this week. And not a lot of banks showed strength. AD lines, again, all-time highs on the markets. Certainly the large caps continue to outperform, but even the small caps, despite the bump in the road on Friday, are moving back towards their prior highs. AD lines at all-time highs. And same here on the NYSE. You notice a little bit of a pullback on most of the long ETFs. And the only thing that moved up this week was bonds, and not a big surprise there because of the interest rates easing. If I look at percentage of stocks above the 200-day period or above the 40-day period, we're both in the about 2/3 of their range. Certainly not extremely overbought, but above where they normally exist. And if I look at my 12-week new high, new low, or 3-month new high, new low, we are not quite at must reverse, but we're at a place where markets have reversed. So we're not overbought to the point where an extension is inevitable, but we are at a place where some markets have reversed. Daily McClellan and weekly McClellan still have some lingering divergences. The buckets now show less extension than they have been showing, with 60% of the stocks being above the midline of their Bollinger Bands. But as you could see here, very few stocks are above their Bollinger Bands. So I would say no signal there. There was no evidence of a Hindenburg-Omen firing. Now that's one thing that I would watch, because you expect these to be occur after tops before a big correction. We had last ones in early November, mid-November. We don't have a whole lot of new lows, and you require those to see the Hindenburg fire. Market tone, still overall more green and yellow than yellow and no red, so still strong but a bit weakened. And you could see we now have some red showing up in some of the sectors here as well. I think that's financials and and materials show the red. Now, if I look at my Q tools and I look at the market on Friday, you can see the staples, the energy, real estate, and utilities are the ones that showed strength, and the biggest weakness being materials. Healthcare sold off. Actually, we look at one day, materials at 1.3. Information technology was down as well, 0.87%. This is just another way of looking at returns over 1, 2, 5 days, 10 days, 1, 2, 3, 4 months, and so on and so forth. And we could see energy's been up now near the top for the last several months. We can see real estate made a big rebound, as did consumer staples and utilities, with the market sell-off on Friday. Now, one thing that's occurred during this last couple weeks is the Canaries have joined the party. This is an extended Canaries group, adding Tesla, Apple, Booking, and Baidu to the typical things. But we broke out and we melted up here. Clearly, this is not a sustainable move, and the best case, or the best bad case, would be a sideways move. The best case, obviously, would be go to the moon, but that's not usually what happens. But clearly, the Canaries have joined the party. This week is all about employment, with the non-farm payrolls and unemployment rate on Friday, weekly jobless claims on Thursday. We've got a number of Fed heads speaking. We've got ADP employment on Wednesday. ISM manufacturing disappointments there have hurt the market in the past. So there's a number of potential market moving events. What we don't have is a ton of earnings, but you can see we do have some here. Lennar becoming one of the first home builders, Bed Bath & Beyond, a retailer, more home builders with KB Home on Thursday. As I say in the lower right-hand corner, it's a judgment call to hold stocks over earnings. It's bad judgment to not know when your stock's earnings date is scheduled. So what are my thoughts? The Santa rally fizzled this week as most averages finished lower by a teeny bit. The S&P was, the NASDAQ, I think, was up 0.2%. The FANG stocks led the market into year's end. I certainly helped my portfolio. Volume will return this Monday. And will we see FOMO with those that missed out on this rally trying to get in, or are we going to see more folks looking to book some gains and the market selling off, especially with the potential for more volatility related to Iran? Now, everybody wants to know how I do in the market, and how do I measure it? So I don't know what the right way is to measure. I started the year with $1 million in my trading account. And if I look at my profits over the year, this is with me taking money out along the way to buy toys, my profits were up just under $700,000. I had another account, a smaller account that I trade, that I started with $100,000, and I doubled that and ended up with $202,000. So that means I had $802,000 of gains on $1.1 million of base. So to me, that's the best measurement of my return. It's in the high 70s, because at the end of the day, I put money in the bank. Others will give you a list of their trades and add up all the percentages to give you their performance. Maybe that's a better way of doing it. I cheat. I cheat because, one, sometimes I do stocks and sometimes I do options. When I do options, I get some high octane gains and most likely limited losses. That would augment the model if I just add up the percentages. I cheat in that I have margin. So even though I have $1.1 million of base cash, I might go 20, 30% or more in margin. So that will augment my returns as well. But to me, what matters is how much cash I have in the bank, because that's really the money that's at risk, and what's my return based upon that. And the other part that would be considered cheating is I compound the gains, because I don't take the money out just because I made money. I might be leaving some of that money in and investing it again and again and again. At the end of the day, I think the one that most accurately reflects your own accounts would be how much did you have on January 1st and how much did you have on December 31st. Now, the funny thing is I saw over 6.5% gain on a much larger number on Friday, but came back to earth with the sell-off on Friday. Thursday was 6.5%. Friday left me up about 2% for the first 2 days of the year. I'll take that, although I have to admit Thursday was fun. So longer term, I remain bullish, but there's lots of short-term events that might interrupt the bull. As I said, we have employment data this week. What's Iran's response to the missile attack in Baghdad and some of Trump's threats today about we have so many sites identified. How will the shift to left in the Democratic Party affect us as this year goes forward? China Phase 1 seems booked and ready for signature on the 15th, but what about Phase 2? Impeachment, it's not going to go away until the Senate votes it out. It's hard for me to believe that even with a smoking gun that they'll flip 20 Republican senators in an election year. And then the wild card is, will the Fed surprise us and turn hawkish? So there's lots of things that can derail this market, but if I had to guess, we'll be higher later in the year than we are right now. Not to say we don't have some volatility coming first. So let's take a look at what the charts are telling me and see what I'm planning on doing. So you all know I like to go into TradeStation and go through my 6-point analysis of each of the indexes. Point number 1, am I in a green buy or a red sell? Well, we saw on 1, 2, 3, 4 trading days a sell come in, and 2 days later a buy came in. So we're at this point in the market where we're flip-flopping. On the weekly and the monthlies, we're still in a buy. Are we blue or green? We're blue on the daily and weekly, which tells me there's some indecision here. Also tells me I could do whatever I want from a trading direction. If it's green, I should only be long or holding. If it's red, I should only go short or holding. Third thing I noticed, these red dots, these are evidence of MACD divergence, higher highs here and lower highs here, a sign of perhaps reduced participation and potentially a top. So that's concerning. We're at the top of the envelope. That's the fourth thing. That's concerning. Our weekly bongo has not wavered. That would be music to the bulls. And we dropped down from where we were a week ago on the high jump bar. Let me see if I get to it. Of 94, 95% there. And here we were at 98%. And with the sell-off on Friday, we pulled back down to 86.84. So that takes away a lot of the overheating. That's the E-minis very quickly. Oh, excuse me, my dog beckons. Almost like clockwork. Every time we bring him back from the kennel, it becomes a war between who's boss. Right now, he's winning. So the NASDAQ has dropped from the high 90s to 89. Other than that, it looks very similar to the S&P. On the Dow futures, still in a buy signal in blue, have dropped to 87. And the Russell futures, different. They're in a sell signal. They turned red, dropped to 80%. So all of this tells me is I'm worried about a top. Tops can take time to occur, and you can run up the outer envelope for some time before you roll over. But at least the Russell seems to have broken first. We'll see if the others follow, or do we get a bounce and a reversal. If we want to look at things like the dollar, we can do that as well. And you can see that the dollar has some bullish convergence, not bearish divergence here, where lower lows out of falling, which might mean a reversal is coming. It's still in a sell signal, but has turned blue. Gold had a big day on Friday, although the miners did not as much as the metal. Now to the outer envelope, it's at 70% for extension. The weekly has gone bullish, as has the monthly. And silver also bullish. So markets have shown some clear changes from a week ago, and it'll be interesting to see how they open up this week and how they trade. Next, I like to open up HGSI, and I'll go into Major Markets Plus, which are 25 of the key markets. Then I'll hit my warehouse view, and they'll open up over to my right. And then I will rank them using the top-down view, which looks at only price and volume, and then make sure I'm sorting by raw combo. The strength of the market comes to the top, which was oil, gold, small caps, silver, surprisingly small caps. There must be a lot of oil producers in the small caps. What lagged were the growth areas of biotech, semiconductors, S&P 100, 500, S&P 1500, NASDAQ 1000. So obviously a different kind of week for the bulls. If we open up the S&P 500, start to take a look, make sure we get the right view. Indice views there. Let's open up a weekly. And let's give us some more room. More data going back over a year. What can one say? I mean, we're near all-time highs. And we sold off on the cash markets Friday, but closed with an open candle, which means we closed higher than we opened. One day wonder or something to worry about. I think time will tell. No phoenixes, no change in the bongos. Clearly, a doji on the weekly is a signal of indecision, and clearly that's not surprising. The Dow Jones Industrial Average looks very similar, identical. The NASDAQ, identical. Weekly dojis, positive from close to open, but still down on the day. And then the weakness should be seen in the Russell. And you could see the Russell broke below at 17 and actually closed near the high of the day. So not so bearish. If we look at the IBD 50 ETF, this is an ETF, a managed ETF of IBD 50 stocks. It really didn't change this week. Again, forming a doji here. It's really been going sideways. Actually, as I look at this, I'm surprised that it didn't sell off more, and that's probably a very positive thing. If we look at the dollar, you can see that it actually rallied on Friday despite the impact of the attack in Baghdad that killed the Iranian General. If we look at the VIX, we talked about it already before. I look at things in multiple different platforms. You see it failed at the 200 and came down, although the VIX had a kahuna, which is a bullish signal for the VIX, which is bearish for the market. And then I mentioned that gold was stronger. Here's a big gap up on gold because of fear related to Iran. And then the interesting thing is silver, not as much. And then gold miners surprised me. Gold miners actually closed down on the day. And then oil, you might expect to have spiked, and oil spiked. All right, so now in the 25, 30 minutes we've gone through, I've got a pretty good feeling of what the market's going to do. I'm cautious, but I'm not ready to write off the bull. So then I go into industry groups at Warehouse View. I have 175. If I look at 2-day force, I can see I now have 33 groups that made it to the positive. If I go to 2-day force down, I have 28. So that's kind of a neutral picture. If I look at 5-day up, I still have 37 groups on a longer time frame. If I look at 5-day down, I've got 49 groups. So short-term neutral, longer term or mid-term, I'm starting to see weakness. But as I said, I'm not ready to give up my bull. So I may look at both upside and downside today. I go and rank these by force. I right-click on expiration, and now I see the stocks that come to the top. And I change this to my stock view, and I click on the first one, which is Occidental Petroleum. Make sure I don't have it alphabetical. I don't. And this is what you're going to see. You're going to see stocks in pretty long-term downtrends that had a big move up the last week or two and a gap up on Friday. You look at it the weekly here, it crossed over the magic line on its relative strength. That doesn't look bad to me. A person weekly buy on a week ago. And we've been in one now for about 10 days on the daily. I'm interested in this one, which is Whiting Petroleum. It looks very similar, especially if you look at the weekly. but I could go through many of them. Concho has already broken above the 200. The good news is it's probably less risky. The bad news is it's already had significant move. Hess trading above its major indexes with a positive move this week as well. Pick your poison. There's lots to like on the energy space. Now, electrical power equipment I thought was interesting, and then I looked at who it is. It's here because forces price change and volume, and your average volume on GE is 56 million, even though it had a very small price change. So looking at GE, I see a stock that's been in a long-term downtrend that's had a major change. It broke above its moving averages, pulled back, and broke out again on Friday. Mobile breakout from a squeeze, multiple pocket pivots, a kahuna, very bullish pattern. I see nothing wrong with buying GE. It's boring, doesn't have a lot of growth, but do I think it's going higher? I think it's going higher. The other stock above its, the average of the group was this BWX Technology. Makes money, tepid earnings per share growth, nice uptrend, pullback, breakout. I have no issue with that, except 431,000 shares is kind of light for me. Internet media, click the index group. Baidu, of course, after I sold it, it's had a nice run. Broke out above its 200. Looking at the weekly, this looks like it's got a longer way to run. It would not be a bad time to buy it again with this breakout above the 200, mobile breakout, kahuna, and a pocket pivot. IQYI, which has been a beaten up stock for some time, has broken out again, mobile breakouts, pocket pivots, kahunas. Not real happy with its earnings per share. Google, all-time highs, pull back here. Facebook, perhaps the best earnings per share growth in the future of all these stocks, back to its highs before it got into some of its privacy issues. A number of things to like in the internet media space. Infrastructure software, when I think of this, one of the things I think about is antiviral software and other things, especially since some of the concern with Iran might be that they resort to cyber warfare. CrowdStrike is a IPO, recent IPO, kind of down to as low as it's fallen at $50, $52 a share. The group had 5 new buys, including CrowdStrike on Friday. 78% are in a buy. Kahuna, pocket pivot, person buy, mobile breakout from a squeeze. To me, this looks interesting here, but it is an IPO and doesn't have the world's greatest amount of data. ServiceNow, pulled back, it's already started to run. I'd rather have bought it back down here. It's probably not too far to consider. Fortinet, high base, breakout, cyber warfare company. Palo Alto. The one I own is CyberArk, and CyberArk is at a good buy point, I believe, here as well. So these could run in response to the terror. Now, with interest rates falling, big dividend payers like MLPs might gravitate to the top. Here's ET, long-term downtrend, moved up, 200-day moving average is in play as resistance, a 9% dividend payer. Target is 8.3, One OK is 4.6, Kinder Morgan is 4.5, Cheniere is no dividend play. These are stocks that I would have looked at as dividends. They've not been great performers. Perhaps with the price of oil going up, you'll get more than just a dividend. Application software, a couple here looked interesting. NetEase broke out here, probably too extended for me. Look at the high jump bar on HGSI. Twilio, I have interest in, pullback, sideways move. Mobile breakout from a squeeze at Kahuna and a couple of pocket pivots, and had a positive day on Friday, showing some strength. Salesforce, just, not the best chart pattern, kind of loosey-goosey, but at the top of its pattern, and a company that is just a leader in cloud-based computing. StoneCo, I believe they do some finance work in South America, technology for payment processing. Gapped up on Thursday, didn't do much on Friday. I would have bought it on Thursday, so that means I probably should be interested in buying it. Add that to my buy list. Anaplan is one that I'm interested in as well. 2 kahunas in a row, mobile breakout from a squeeze, couple of pocket pivots. This is another application software provider. Seems to have found its leggings and moving up. And I think that's enough on that group. This is top-down investing. I would go through all 10, make some thoughts about them. I might consider looking at the ones with the biggest movement down. Probably not, because I don't like to short a lot at all-time highs, and certainly not the groups that have been leading. But we can find the groups that are selling off. Technology, microchip, Broadcom, you see the big red bars here. Qualcomm, combination of volume and price move leads to this positioning. What I end up doing is I build a list of lists, and I end up with a group of stocks that are in my buy and sell points. And today that was 657. I then look at these 657 stocks through various tools, various filters. This is something that one of my friends, Chris Tuck, put together that brings some of the better performers to the top. Here's Hain Celestial, mobile breakout from a squeeze, move up off the 50, pocket pivots in Kahuna, that looks interesting. And then one that made it through multiple of my list, EPR, pullback, mobile breakout from a squeeze on Friday, Kahuna, pocket pivot, and a new person buy signal. This one looks quite interesting as well. But if I look at my buy watch, these were a bunch of stocks that I picked for this week. Just take a look at them and see if we can find any stories and maybe pick one and highlight it. So, application software, I showed you Anaplan, Twilio, StoneCo. Those are some things that I liked. Defense, not sure how long this plays out, but these can run for a while after the type of thing that we saw with Iran. Here's a typical pattern. They were all pulling back towards major moving averages and then had Bible gap ups on Friday. Interestingly, on Thursday, they had a kahunas, pocket pivots, and a mobile breakout. So I'm very interested in L. Harris. Internet-based services. These were a couple. VeriSign is one that I like. And I'm going to come back to VeriSign and work it up of how I might play it. Several REITs looked interesting. EXR is another good dividend payer, pullback, sideways move. Mobile breakout, Kahuna pays a 3.3% dividend. Solar Edge, I've talked about multiple times, finally broke out. Look at the fundamentals. This is something that should certainly go higher and higher. And then on specialty apparels, if I'm looking for something that's pulled back and maybe starting to show some life, here's a sideways move in limited brands. And look at what happened on Friday, high close doji, as well as a mobile breakout from a squeeze, a pocket pivot, and a kahuna. So those are some of the things I like. Let's look at VeriSign for a few minutes and how I look at things. Oh, my goodness. My dog is going to wake up my wife, and that will not be good. All right. VeriSign, global leader in domain names and internet security. So it fits right with what we talked about for CyberArk and others. Clearly meets my desire to find stocks that have been in an uptrend that have pulled back to support and seem to be breaking out. Okay. Lots of momentum factors there. So I know that the way that I trade, I start by figuring out where my buy stop goes. And on a stock, high was 201.46, low was 193, close at 288. I'd probably want to see this get above the high of Friday, or 201.50, before I take the plunge. So 201.55. Okay. Now, where am I going to set my low? It's a pretty big bar. $192, $80, $97, $190, $74. So I have a choice. I could set my stop at the low of the prior 4 bars here. And frankly, that would be 190.74, so 190.70. Which puts me at 11 or 10.80. So it's less than 6% for a stop. I'm fine with that. But I probably would say that's too much, and that if it went below the 200, so if it closed, say, below here, this bar, the low was 194.20. So I think I'm going to look at 194.15 as my stop, and that means I'm looking closer to this point here. Now, let me open up another program for a second. Where is it? Hold on one second. Since I don't have easy access to my screen with everything open, I'm just going to open it through here. This is Options Pro. This is a program that you can get through eSignal, through VectorVest, or through Dynamic Trend Inc. right off their website. It's a great... Okay, I'm going to stop and do that. Okay, so I'm going to wait to be triggered by trade of 201.35. That's going to impact the pricing of my options, but we closed at 288, so I'm only looking for a 50-cent move, so it won't affect that much on a $200 stock. Now, I've run my analysis, and these are the trades that I would consider. If I wanted to buy 100 shares of VeriSign, it's going to cost me $20,000 and change. I'm going to be risking the entire $20,000 and change, but my break even is going to be the price of the stock when I buy it. Simple trade. This line here, this blue line, shows you how much I go up in profits as the stock goes up in price versus my losses. Now, I may not want to spend $20,000 to control 100 shares. I could spend $702.50, and I would be buying a February expiration call. And you could see the benefit of the call is that it has a very steep profit area. My loss is capped. Over here it can go to infinity. The loss is equal to the amount of money I'm paying for the premium, which in this case would be $702.50 to control 100 shares. The other thing that's different in buying a call, it's actually got to move $702.50 worth. It's got to move to 207.03 for me to break even. So I have to move enough to cover the cost of my call. Selling a put actually generates $254 in my pocket. The problem with selling a put is I better be right on my direction. I'm capping my gains as to the amount of the put I'm getting. It is even profitable if it moves down in price, equal to the amount of money I'm getting up for the credit, but I have unlimited downside risk. Of course, you're not going to get unlimited downside move because you're going to sell it at some point if it goes against you. Now, one of my favorite ways to play this is doing a synthetic stock where I buy a call and sell a put at the same strike price. And now I've got the exact same P&L of buying the stock, but where I had to pay $20,000 or $21,000 to buy 100 shares, I only have to pay $103.80. That, to me, is a reason to do a synthetic. The benefit of the synthetic is you get all the move up. The disadvantage of the synthetic is it's got to move a dollar in your favor, but more importantly, you carry unlimited risk to the downside. So the trade that I typically do, I'm showing RPD, which I did the same trade here on RPD, and I did a small trade. I bought 40 contracts at the money, sold 40 puts at the money here, and then bought some puts to protect me. I'm up $8,000 on that trade in the 2 weeks since I took the trade. But if I go back here and change this to VeriSign, boy, my dog is being incorrigible today. Every time I pick him up from the kennel, he gets spoiled there. So what I like about this spread here, which isn't showing me what I want, so let's do this. Let's go back to this spread here and ask the question, what happens to my risk and my cost if I add another call? So I'm going to edit. I'm going to add another option leg, and I'm going to buy. I'm going to change this all to February. I'm going to buy a 190 put, say a 195 put. So what's going to happen now is for $502, which is less than the call was at $700, I capture all the upside. I have less move for it to make 205.03 as profitable versus 207.03 on the call, and I've limited my downside. So this is the type of trade I'm likely to take, and I'm going to jot that down and potentially take that trade on Monday. Now, Monday comes. I care about what the market's doing before I do anything else. I'm going to put my stocks that made my buy watch list into my trading platform, in this case TradeStation, where I'll be able to monitor them during the day for things like Q signals, HGSI signals, pocket pivots, Bible gap ups, and then John Person signals. I also know by using this indicator here when the earnings are due, and I know that nothing is due in the first couple of days, although KB Homes looks like it's due on Thursday. And then I look for signals to occur intraday, and I take the trades. I will probably work up, similar to VeriSign, a number of the stocks on the list that I liked that I may want to go play with. VeriSign was one of them. I had an interest in one of the defense stocks. This is Limited Brands I have an interest in. Now I'll probably buy shares because it pays a 6% dividend. L3, which was the Harris defensive stock, I might look at this as well. Bottom line is, I don't think this is done going up. I'm not sure how many days we're going to have of trouble. Hence, I put puts on positions and bought some VIX on Thursday after such a big move. I still found some things on this list that I like. Feel free to stop the computer, take a look. Duke Realty is another one. Same pattern, uptrend, pullback, and here we got a mobile breakout from a squeeze, a kahuna, and I find this to be interesting as well. So on that note, I'm going to say goodbye. Remember, this is for education alone. Anything I say can't be used against me, and trading options is considered risky, so please know what you're doing before you trade options. Goodbye, everybody. Sorry for my dog.